and this particular one a little bit earlier. This is the lecture that I'll say is the calm before the storm. Next lecture, the week 10 lecture, generally speaking, is long. And it'll feel long because it's basically one big information dump. And basically week 10 is different than the other weeks because week 10 is a lot of little rules, and therefore it's really a big memorization fest. So you just have to, there's a lot of little rules that you need to memorize. So it's a little bit different than the rest of the course because for the most part, hold on a second. Sorry. For the most part, the rules, at least there's big concepts behind the rules. There's multiple steps behind many of the rules that you guys are being taught. Week 10 and even the administrative stuff that we're going to talk about today, these are more just, you got to memorize them and just apply them the best you can. So week 10, the homework is also very long, but it is intended to be a more comprehensive review of the course. So for week 10, I really want to urge people, even though it is going to be a little longer than normal, to go for it because of the fact that it's really more a review and a prep really for the course itself. So want to really just preface that there. So if you do finish early, do consider looking ahead and starting to work ahead on the week 10 homework. Okay. All right, let's go through here the assignment. I'm just going to bring up a file here and just going to bring up the textbook. So this week we had 2 custom problems as well as some assignment problems. So the first assignment problem was a cap gain reserve problem, which was 8.5. So you have a situation where 2 tracts of land are being acquired, and and the intent was to develop them, but instead a decision was made to sell the tracts. So Aaron got 2 attractive offers, and so now what they're doing is they got a down payment and they're going to get some interest in both cases. And then the question is, what's the impact to NITP as a result of transactions? And you're being asked to comment on 19, 20, 21, and 22 separately, okay? And they want you to show what the impact is if you had taxable capital gains and interest receipts, okay? So here's my first question before I share my screen and start walking you through. Actually, I'm just going to show my first thing is, what's the first step that you should have in this case? What's the first step? Anyone? Not quite. What's the first thing you always have to do What's the first thing you always have to assess? Jandeep, I don't know what to say. I can't help you there. So what's the trigger for capital gain reserves? What's the trigger for right? Because remember, you always have to assess trigger first. So what's the trigger? No, no. So remember, cap gain reserves. You only worry about cap gain reserve rules. That's right. If you receive proceeds over several years. So the trigger is: did you have a disposition that resulted in a gain, and are you collecting proceeds over multiple years? Right. So so I haven't shared my screen yet, Desiree. I haven't shown. I'm not showing anything yet. I mentioned that I was going to ask the question before I shared my screen. Now, after you've decided the trigger has been met, then what is your next step? And some of you guys were already making reference to it. What's your next step afterwards? Now it's on the screen. Right. So what's your next step? What's the next step, guys? I'm trying to get you guys warmed up. I don't see enough typing in chat. Okay, the next, you have to identify how many dispositions, right? So again, just like before, even though each particular topic has their own steps, you always have to make sure you're trying to identify the number of dispositions that are in the question in case there are any deemed dispositions that you miss. Okay, so in this case there aren't any deemed dispositions, so now you can just go right into this, right? And again, you had to have a gain. So the first step is you need to calculate the gain from the transaction. So in the first case, they tell you that was 879 was the offer, and the ACB is 325. For the second one, all right, so that's 554 as a gain. The second one, $1 million proceeds, 430 ACB, it's 570 as a capital gain. Okay, so you've got your capital gains, and then they tell you that you're going to receive the proceeds over time, and they tell you that in the first tract, you're going to get 45% as a down payment. Okay, so you're going to get 45% as a down payment, and then what they're going to do is they're going to pay the balance on December 31st, 2022. Okay. Now, if you think about this for a second, before you actually go into the question, you should already be able to determine what method will prevail. So remember, in capital gain reserves, we said there are two methods, right? There are two options, and you have to calculate out both options. You have to choose the option that's going to give you the lower reserve, the crappier reserve. So you have to sit there and say to yourself, well, what options will prevail in each year? So in 2019, for example, without even doing numbers, which option would you expect to prevail in 2019? Which option would you expect to prevail in 2019? Well, which option? Hoy? Yeah, the lesser amount, lesser reserve, but which option? Which upfront? Which one would you expect? Because your uncollectible option, right? Your reasonable reserve option. What will be the percentage on that reserve? Right. And then your 5-year rule will get you what number? It'll be 80%, right? So right away you can sit there and say, okay, year one, 2019, 55% is lower. So it's going to have to be the reasonable reserve. Year two, which is 2020, again, your reserve drops down to what? 60%. So you're going to sit there and say, well, 55 versus 60, well, 55 is still crappier. So you're going to say reasonable reserve is still it's still what's going to be there in year two. 2021, which is year three, now it's 55 versus 40. So you're going to flip flop. You're going to expect 5-year reserve to prevail in year three. And then in year four, the last year, again, it's 0 versus 20 because, again, everything gets paid. So you expect another flip flop and the reasonable reserve option will prevail, right? So the reason I'm saying this is because in an exam, you should be doing this review or this type of thought, go through this thought process before you even jump into the numbers, because it's very simple to do. Okay, so now we go through the calculations. So we're going to look at tract 1 first. We're not going to look at tract 2. So we're going to look at the tracts separately. And this is this student homework that I pulled. You know, nice thing about it was they looked at things separately. So here's your 55%. So your reserve will be 3047, right? And again, when you calculate your reserve, you take your gain, right? So that's 554. And now you go and do your reserve, right? And again, 45% is paid up front. So 55% is what's uncollected. So under the reasonable reserve option, you're going to get a 3047 reserve. Under the cap gain reserve rules, you're going to start at 80%. So that's going to give you 443,200. Of course, that's higher. You have to get the lower reserve. So for first year in 19, your reserve is 3047. So if you take a look at your capital gain, right? Your capital gain is going to be 554 less 304,700. Okay? So again, 554 right? Less the 304,700. That's going to give you 249,300. 249,300 times 50%. That's going to give you 124,650 as a capital gain. Okay. When you calculate the interest, okay, the question specifically says, guys, we're going to look at the balance at the beginning of the year, and then you're going to times that by the interest rate of 6%. So if you think about it, 19, 20, 21, 22, the balance at the beginning of the year is the same. Okay, it's going to be 55% of the 879. So if we look at 55% of 879, right, that's the 483, 450. So 483, 450 times 6% is 29,007. So basically, every year you're going to have 29,007 as interest income, and you're going to have, in this case, the first year, 124,650 as your taxable capital gain. Okay. Okay. Any questions? Okay. Couple no's, just two people. People sleepy this morning, or is the weather already getting them down? Feels like the energy level is lower than normal, even though I can't see people's faces. All right, 2020. So again, we expected option one to prevail. So of course now your 5-year rule drops down to 60%. So at this point in time, you take a look at this, and right, we expected option one to be lower. Option one is lower, so that's good. And in this case, now we sit there and say, okay, let's add back prior year reserve. Let's deduct our current year reserve. Oh, wait, the reserve hasn't changed. So therefore, there's no capital gain to recognize. So nothing happened in 2020. Okay. And again, interest is the same. So 2020, you just have 29,007 interest income to recognize. 2021, now we expected a flip, right? This really should be 4%. We expect a flip. So now what happens? Oh, it went from 50, it's 55 still on the reasonable reserve, because again, nothing's been collected. Oh, now it's gone down to 40. Okay, now it's gone. Now we have a flip flop. Okay. So now when we sit there and say, okay, let's go and add back prior year reserve to income, we add back our 3047, we deduct 221.6. The difference, that's our capital gain for the year. Okay. So again, simple math. There's my taxable capital gain. The interest will stay the same because there's no change in opening balance. So you're just going to have the capital gain and the interest in your NITP. Okay. Last year, you've collected everything. So now you're at 0. This has gone down to 20%. Okay. So that's a small reserve, but again, 20% versus 0. Well, 0 is going to win. So now you sit there and say, I had 221.6 that I've reserved for last year, put it back into income, no reserve. All right, let's put the rest of this in as, let's just tax the rest of this capital gain. And so now 50% of that is 110.8. Okay. And the only difference is here, this student, they made a mistake here. Why? Because again, the interest is based on the beginning of the year proceeds. So my beginning of the year proceeds is still 483, 450, because the last payment made in the question is right at the very end, December 31st, 2022. So because this student made that error, there should be 29,007 interest even in 2022. And then you get 110.8 as your taxable capital gain. Okay. And then the last thing you do is you always do a check. Okay. So at the very beginning, we sat there and we said, okay, we should have 554 as a capital gain, or if we do 50%, right? If we do 50%, you should have 277 as a taxable capital gain. So now what you do is you sit there and say, well, what were the taxable capital gains over the years, right? So again, in 2019, or it's 2019, okay, 2019, we said we would have 124,650 capital gain. In 2020, zero. In 2021, 41,550. And in the last year, 110,8. Okay. So in total, those three numbers add up to 277. All right. We expected 277. We recognize 277. We're good. We got it all. Okay. Any questions on the first tract? Any questions? Or are we good? It's fairly simple, I think, capital gains reserve. You understand 2020? All right. Well, again, 2020, right? So you have your reserve of 3047, right? 1 year has passed, so now under the 5-year rule, you go down from 80 to 60. These numbers, you look at this, 3047 still crappier, so there's no change in your reserve. There's no capital gain. Does that help you, Harrison? Because I'm not sure if what specifically do you not get about 2020? Yeah, you do. We said we recognize it right here. You recognize the interest. You're recognizing the same amount of interest every year. So 2019, 2021, 22, you're recognizing the interest every year. Yeah. There's just no capital gain in 2020. Yeah. So are you good then for the whole question or for track one, Harrison? Or do you need me to go through anything else? So you have to be careful, Chi, because you have to remember when they say interest is due, that's just when they have to pay the cash, right? The reality is they are incurring interest every year, right? Because remember, when you're doing capital gain reserve and you're the vendor, what are you doing? You are effectively lending money to the purchaser. You've effectively extended a loan. Well, they've extended a loan from since 2019, right? It's just that in this case, what they're basically saying was they're not requiring them to pay interest in 19. They're going to make them pay the interest starting 2020. So 2020, they're going to have 2 years of interest to pay, right? Does that make sense, Chief? Because again, you're not a vendor. If you're the vendor, you're not going to want to forgive $29,007 for free. Okay. Any other questions? Those are good questions overall. Okay, I'm gonna jump onto track 2. So track 2, if we look at track 2, you're gonna get your 10% up front, and then they're gonna pay 30% over time. Okay, so again, 10% up front, and then they're gonna pay 30% over time. So if you think about it again, and you're trying to think, well, what methods will prevail, right? So year one, again, it'd be because in this case you got 10% up front, so you're going to have 90% collected in year one versus 80% over the 5-year rule, right? So you're going to think, well, 5-year rule is going to prevail in year one in 19. In year two, you can go from 90% uncollected to 60% uncollected. Well, 5-year rule goes down to 60. So you should see a tie in year two. Year three, you go down from 60 to 30 versus from 60 to 40. So again, 5-year rule's at 40%, reasonable reserve is at 30. You're going to expect your reasonable reserve rule to win. Okay. And then in the last, so that now you'll have for sure flip flop, right? Because you start off 5-year rule was prevailing in the beginning. And now in the last year, again, reasonable reserve will win out because it'll be 0 versus 20. Okay. So that's kind of what we expect to see when we go through this. So now we go through when we go through the again. This one, the gain is $570,000, right? That's the capital gain. Okay. So again, year one, 90%, 80%. 80% is lower. That's what we expect. Reserve should be 456. So again, 570 less the 456, that gives you 114. 50%, 57,000. Okay. And again, in this case, you have 900,000 uncollected at the beginning of the year. So 900,000, 6%, that's 54,000. Okay. So you're going to have 54,000 interest income, 57,000 taxable capital gain year one. Okay. Year two, again, now in 2020, you collected 30% at the end of the year. So you get 60% uncollected versus 60% on a 5-year rule. We said we were expecting a tie. Here's our tie. All right. But regardless, your reserve is 342. All right. So last year we had a cap gain reserve of 456. Now you're going to have 342, 114 taxable capital gain, 114 capital gain, 57 taxable capital gain. Does this make sense? Yes, it does. Why? Because you were using 5-year rule in the first year, and basically you're using, argue you're using the 5-year rule again in year two. You're recognizing an equal amount, right? Your reserve is 20%, right? You recognize you were at 80%, now you're at 60, so you're recognizing 20% chunks in both the first and the second year. So you would expect the taxable capital gain to be the same in years one and years two, and it is. So that makes sense. Okay. Again, you collected 30%, but you collected it at the end of the year. Remember, the interest was based on what is the balance at the beginning of the year. So at the beginning of the year, you were still at 900,000 uncollected. So it should be at 900,000 at 6%. Okay. So it's still 54,000 interest income in year two. Okay. Year three, now you went down to 30. Now you're down to 40 on the 5-year rule. So now here's our flip flop. Now reasonable reserve is going to be the method that prevails. Okay. So again, your reserve is 171. So you went from 60 to 30. So again, 342, 171 is current year reserve, 171 is your capital gain, 50%, 85.5. Okay. Now at this point, again, you got another 300,000, but again, that was at the end of the year. So your uncollected proceeds at the beginning of the year, maybe I should put that in there to make that clear, right? Is 600. So 600 times 6%, your interest is 36,000 in 2021. 2022, now you're at 0 versus 20%. So again, 0 is going to win. So you should have no reserve. So now no reserve, prior year reserve 171, no new reserve. There you go. There's your capital gain, 50%, 85.5. And again, at the beginning of the year, you had 300,000, right? So again, uncollected proceeds at beginning of year is 300,000. So again, you have 18,000 of interest income, 85.5 taxable capital gain. Okay. And again, we want to recognize 285, right? So again, if we go all the way back here to the beginning, right? 570 times 50% is 285. So we want to recognize 285,000 taxable capital gain. So again, year one, we recognize 57. Year two, we recognized 57. Year three, we recognized 85.5. And year four, we recognize 85.5. And the total of that, I don't know if you can see that, is 285. So we need to recognize 285. We did recognize 285. We're good. Okay. Any questions on track 2? No, track in all cases, we use what's the balance at the beginning of the year. There is no difference between the questions. I'm not really sure why you're thinking otherwise, right? And again, in the first question, what did you get? You collected 45%, right? So we collected 395,550 up front. 483, 450, that's uncollected, right? So there's your uncollected proceeds at the beginning of the year, right? Remember, the down payment is made Jan 1. So uncollected proceeds at the beginning of the year is the 483, 450. Here, again, you got 100,000 Jan 1. 900,000 is uncollected. And again, in 2020, Jan 1, 2020, 900,000 is the uncollected amount. It's always been uncollected proceeds at the beginning of the year. Right? Remember, the question specifically told you the interest is based on the beginning of the year balance, not the end of the year. Is that clear? Okay. Okay, so no other questions. Just again, I wanted to double check. There's no other questions on track 2 on the cap gain reserve rules. Okay. 8.7, principal residence. You have Annalisa Filson. She was married to Spiro. And of course, they tell you specifically husband 75, Annalisa's 32. Makes you think of Trump. And has been in poor health for a number of years. So They live in an Ottawa home which Spiro purchased as a wedding gift for her in 2008 for $628,000, and Annalise is the sole owner of the property. 2010, on a business trip, she met Arnold Schwartz. So this tells you this is someone who wrote this question is fairly old. I'm not even sure if you guys really know who Arnold Schwartz is now at this point in time. But anyways, then she met Arnold Schwartz, and then of course then they started doing their own thing in the downtown Calgary condo, and the condo cost $325, and she spent time with Arnold every year in this property. Okay, so again, in both cases, the Ottawa home and the Calgary condo, they're giving you a fact pattern that says the two residences were ordinarily inhabited. Okay, 2019 comes around, and the Spiro finds out about Arnold, so therefore he removed her from the will, and they moved out of the Ottawa home, or he moved out of the Ottawa home. And then in Calgary, Arnold told her that now he's changed to a different person, and therefore she decides to sell both properties, and she went to a religious community. Okay, and that took a vow of celibacy. All right, so then they give you some facts around the sale of the homes. So again, number one, if we were to look at trigger, what would you want to see as the trigger? So this student, for example, they didn't have the trigger in here. So again, if you want a trigger, what's the trigger for principal residence? Primarily residential residence place? Not quite. I mean, that doesn't really. So number one, is that good enough, or am I missing something in this trigger? They told you that Anna lived in both properties in the years, right? So each year she lived in both properties. So what am I missing in this trigger? No, no. I'm just talking about trigger, right? I'm not going through, and we're just talking about when do you have to worry about the principal residence rules? If I sell a principal residence for a loss, does it matter? Do you care about these rules if you sell at a loss? No. You have to sell at a gain. Or I shouldn't say capital, I'll just say realize. Yeah. Right? Did you sell for a gain? That's the most important thing. Because if you don't sell for a gain, then you don't care. Okay? Okay. So both offers sold for a gain. Okay. So now you go through your steps. Again, number one, you always want to make sure how many dispositions, right? You're always looking for your deemed disposals. So were there any deemed disposals? No. Okay. And if it helps, you can say no deemed disposals. Okay. Right. And here, what this student said was, well, maybe I should ask, put in a step, does the property qualify as a principal residence? And my view is you had to do that up here. So if you want, this assessment really should not be down here. It should be really as part of your trigger. Okay. Well, Marie, if you have one house that's sold at a loss and the other's a gain, well, what would you do? You just allocate you designate the principal residence that was sold for a gain you just designate the years to that residence, right? Why would you ever designate the house that sold at a loss? Why would you designate that one as a principal residence? Like, do you want to exempt a loss? Are you saying that as a taxpayer do you want to avoid recognizing a loss? Yeah, right. Well, no, there would be no reason to not claim the loss, right? So you never designate that property if it's at a loss. The other thing I would say is if you read the rules, there are forms and stuff you have to file when you are claiming the principal residence election. But again, those forms are only required if you're selling for a gain. Okay. Because again, these rules only apply where there's a gain. Doesn't apply if there's a loss. Okay, so now we calculate what's the gain on each property. Okay, so again, they tell you she sold the Ottawa home for $724. Okay, so but they tell you there are real estate fees of 4% on the sale price. Okay, so if you think about this for a second, that real estate fee in effect is a selling cost. Okay, so there's two ways you could present this. You could say, Chris, I'm going to show the proceeds on a gross basis, and I'm going to show ACB, and then I'm going to show my 4% fee. Okay, because remember this fee of $629,860, this fee is directly tied to the sale. If you didn't have the sale, you wouldn't pay this fee. Okay, so you can, on tax returns, most of the time they'll want you to break these out. But for all intents and purposes, these fees are effectively reducing your proceeds. Okay, so whether you decide to show these separately, or whether in this case, like this student, put it just net, show the net, I'm not fussed either way, as long as you tell me that the fee is going to reduce your capital gain and not be 100% deductible expense. Okay, so some people may say, Chris, can I try and argue that that fee should be deducted at 100%? Because right now, by reducing the capital gain, I'm only getting 50% credit or recognition of that fee. Okay, and again, because this fee is directly tied to the sale of the house, you have to show it as a reduction of the capital gain. You cannot to say it's 100% deductible expense on the side. Okay, does that make sense to people? No, you shouldn't add fees to the ACB. Why? Because ACB represents cost, right? Did you incur this fee to buy the home, Joshua? Did you incur these fees to buy the home? Yeah. So it should not be part of ACB. So in this case, For Ottawa, once you net off your 4%, you should be at 695. On again the Calgary condo, right? They tell you that it was sold for 415. So again, once you knock off your 4% fee, you're going to net to 398 400. Okay, and then they tell you again in the question, right? And here's a key question again, and this is something no one raised, and I was waiting for someone to say something, but no one said anything. Are you sure the cost is 628? Remember, Annalisa paid how much for this condo or for this Ottawa home? Again, she paid zero. So again, why is this not zero? Why is this not zero? Why is it? No, again, yeah, so she's the owner. So what? It's I'm not talking about whether she's the owner. She's recognizing the gain. Yeah, of course she's the owner. She's recognizing the gain. But why is the ACV not zero? She didn't pay anything. What's the special thing you have to think about when you have a gift? It's a deemed disposal. So when we went back here, does that make sense? The new comment, right? There was a deemed disposal. Spiro gifted the home, the Ottawa home, to Annalisa. And remember how it works. The person who holds the property before the event, the deeming event, is deemed to dispose at fair value. So Spiro, when he gifted this house to Annalisa, he would be deemed to have sold the house to Annalisa for 628. Okay? So if he paid 628 for the home at the time, he would just have no gain. Annalisa, she's the one who holds the property after the gift. So again, she's deemed to acquire the home at fair value. So the cost base to her is the 628. Okay? Does that make sense? Any questions on that fact? That is why 628 is the cost base because of the deemed disposition and acquisition. Okay? So, because of the gifting, the home ACB is 628. She paid 325 for the condo. So your capital gain is 67,000 and 67,040 and 73,400 respectively. Okay? So now you sit there and say, again, because we've got both properties sold, we want to figure out what is the capital gain per year. Because again, your limiting factor is the number of years you have. So what is the value of each year for each property? So again, the Calgary home was acquired in 2000 and or was it here? Did it say in 2008? So again, 2008, and then it was sold in 19, right? So that's 12 years. Remember, you have to include the initial year, which is 2008. The Calgary condo, again, she acquired this in 2011. So again, 2011 to 2019. Again, it's 9 years, including the initial year. So when you do your calculation, you have a higher gain per year on the condo, and you want to prioritize your condo. So now you're doing your designations. How do you do it? Well, here's one way to do it. 8, 9, 10, 11. You could say is the Ottawa home. You give a free, and then you have the 1 plus the free year, and that's 2012. And the Calgary condo, again, same thing. You designate 12, 13, 14, 15, 16, 17, 18, 19, and then you give the free year to 2011. So now you've captured all 9 years on the condo. So again, here, capital gain per year is the highest in the condo, so you allocate full to the condo, so there's no gain that you're going to recognize. And again, on the Ottawa home, the rest, right? 4 plus 1 is 5, so you've got 5 designated years over 12, and it's 42% exempt. Okay, so for tax purposes, you take your 67,000 times 42%. That is the exempt portion. Okay, 27,933, 67,040 less your 27,933. That should get you 39,107. 50% of that is 19,553. Okay, so at the end of the day, and I should say that would be exempted, right? Basically, we're saying we're exempting 101,333 because we're using the capital gain designation. Okay. And at the end of the day, 19,553 would be the taxable capital gain recognized. And by the way, when you do a principal residence calculation for the exam, it's important that you show the amount that is exempted as well as the amount that actually is going to be taxed. You have to show both. Any questions? She is good. Or anyone else? All right, so these were the easy questions. Now the custom problems. I'm just going to put this on the side here. So first custom problem, you've got Jack. He's got a number of investments, right? This is Abel's. He's got business profits from Niagara Transport. Okay. He's got business profits from Niagara Transport. He sold 3 company shares. One of those was an SBC. And they tell you in 2009, he had a taxable capital gain that was exempted. Okay, so they told you $15,000 taxable capital gain was exempted, okay, through the lifetime capital gains exemption. So here's my question again. Number one, we're dealing with Abel's. What's your trigger? What's my trigger? Again, what do I have to look out for to make sure that to know when these rules apply? Not a CSB, not a Canadian small business. That's not the right term. It's not CSB, it's SBC, right? So did you have a small business corp, right? Do you have a small business? Remember, because to be a small business corp, you had to have certain criteria, right? That was being met. You have that 90-50 test that we talked about last class. So number one is there an SBC, right? So again, did the taxpayer dispose of now? Now, why do I say qualifying investment? And we didn't talk too much about this last class. We went over more the basics of the rule. Why is it that I'm saying, did you have a qualifying investment? What I'd like to do is just get you guys to turn briefly to the Act and the provision I want you to turn to is 39 bracket 1 bracket C. So that's on page 201. So if you guys can just indicate in the chat when you get to there in the Act, page 201 of your Act. Okay. So what I want you to do on the very top right of the page is 39.1c. If you go and look at, the question becomes what types of investments in SBCs will allow you to claim an ABLE. If you go to subparagraph 3, if you start at subparagraph 3, number 1, it tells you shares of the capital stocks. In other words, you buy shares in an SBC, you sell them for a loss, that is qualifying. So that's an equity investment. But then you see in subparagraph 4, it says a debt. So what that means is if you lent money to an SBC, so say you lend money to someone and you're not a bank, okay? You're someone, you just off the side, you lend money. And say in this case you lent money and you weren't able to collect on the loan. First, the company goes bankrupt and you can no longer collect on the loan. Well, in those circumstances, that loss, that write-off on the debt, that would normally generate a capital loss. And what the government is saying is if you loan money to an SBC or you do a debt investment, I like to call it, and you cannot collect that debt, that also will qualify for an ABLE. So it's important to know it's not just share sales that will generate ABLEs, but losses on loans will also generate ABLEs. Okay? So it's important you keep that in mind. Loan losses as well as losses on the sale of the shares, both will result in an ABLE. So that's why you have to say, did the taxpayer dispose of a qualifying investment in your trigger? So in this case, you'd say, yes, taxpayer sold shares of an SBC at a loss, trigger met. Okay? So that's the first thing in terms of the steps. Now, number 2, you go through, there's only one person, okay? And you start, and you look at the dispositions, you look at the numbers, and they're fairly easy to break down, right? And remember what I said before, an SBC is normally going to generate a capital loss, okay? So again, 45,000 loss on Vacuum Co. I think it's Vacuum Co. I put in here. Yeah, so Vacuum Co. We told you is a 45,000 loss. So again, 50% of that is 22.5. Okay. So if we take a look here, and we look at our numbers, you're going to have a 5,000 gain first. Now you're going to have 37,500 from your XYZ Co. The 22,500 Vacuum Co loss. And remember what I said before, you always have to show the numbers as if there was no able first. Because remember, ables are a reclass mechanism. Okay? It's a reclass mechanism. So when you calculate things, because it's a reclass, you show it first, then you show the reclass. Now, we mentioned in the question there was a capital gain that was exempted in the past. Okay? There was a capital gain that was exempted in the past. We said 15,000, right? And we said 2009. But remember, when you do this calculation, you must do things on a gross basis, not on it. Because again, the question is, are you a net loser or are you a net gainer? So if you gross up the 15,000, right, in 2009, the inclusion factor was only 50%. So if you gross it up, 15,000 to 100%, well, that'll be your 30. Okay. So now your business investment loss, the difference between the two, okay, you were a net loser of $15,000. All right, 50% is 7,500, and that is your able. Okay, so we show them, okay, we're going to reclass 7,500. Okay, so that means at the end of the day, the net of these three numbers is negative 52.5. Well, you're going to have a loss carry forward of 47.5. And now you do your able reclass. And so now you end up with 152.5 as your NITP. Okay, does that make sense? If that helps. Right? Again, 15,000 was the taxable capital gain exempted, right, Harrelson? So if I gross up to 15, it grosses up to 30, right? Because remember, 30% is 100, right? So 30,000. Right? So again, but yet do things that are gross. So if we do things gross, there you're a net loser, and then you have 50% to get to 7,500. So does that help? Well, that's in the question, right? In the question, we told you, right? Right here, right in the question, we told you it was sold for a $45,000 loss. That's literally right in the question, right? SBC. That's a number right in the question. Yeah, no, you don't do that. I only told you that I only said Vacuum Co was the SBC. Okay, anyone else has questions? Or are they all good? Because that's what it is, right? Like the issue. So the issue, Hui, is if able rules don't exist, what would you normally get, right? Remember, Vacuum Co shares. You invested in shares. You expect the shares to generate income. You sell them, right? You generate a loss. So again, you sold an asset that's going to help you earn income in the future. That's going to be a capital loss. So that's what Able is. Like that's what it is. You have a capital loss. Able says, let's let you reclass, right? Or reclassify this loss. So in other words, normally it's a capital loss. Well, can you reclassify or recharacterize this as an amount deductible under 3D? Okay. And in this case, you cannot reclassify everything. You can only reclassify a portion. So the net, that still stays in 3B2 little I as a capital loss, as an allowable capital loss, right? So that's the whole point of recharacterize is just pretend. Can we pretend it's something else just for the purposes of the formula? Okay. So you have to show the Vacuum Co loss first. Then you have to show what amount you're remember, this is net zero. This nets to zero, right? So you're just reclassifying. You're just putting it in a different spot. You're not changing the total numbers. You're just putting it in a different spot. That's the whole point of reclass. Okay. So at the end of the day, you could not reclass the whole amount. So what is it normally? Well, it's normally a capital loss because again, you're selling an asset that helps you earn income. So you normally have an allowable capital loss. That's the 45 at 50%. And now you show your reclass. And again, you cannot reclass the whole thing because you got a benefit on the gain side in the past. Okay. Does that make sense, Hui? Like I can't emphasize this enough. A lot of times for some reason, it doesn't quite, I guess students get lost in a little bit of detail. Remember, these are 9 to 0. Because when you reclass something, you're just putting in a different spot. You're not changing the overall numbers. Okay. So, anyways, any other questions? Okay, just give me 1 second here. Just, just hold on 1 second here. I'll be back in a minute. Hold on. Oh. Okay, it's part 2. What would change if instead of 2009, it was 1989? Okay. And the key thing here is in 19, so June is a principal residence in SBC. So why would you be able to use the exemption on SBC? And again, principal resident exemption, when does that apply? Like again, if you look at your triggers, what do you have to have? Like for principal residence, again, what has to happen? What's the condition on a principal residence exemption? Okay, so you have a gain, and the principal residence is to, or the purpose is to exempt a gain. All right. Able is when you have a loss on the SBC. Why would you want to exempt a loss? Yeah, you don't want to exempt. Again, they're totally two unrelated rules. But what you're, is I'm not trying to be facetious, but what I'm trying to show is this is why you need to make sure you understand your triggers and understand the concept, because there's lots of rules. It's very easy to get mixed up on these rules, right? It's very easy. But again, you have to go back to what causes the rule, what triggers a rule, and then you have to sit there and say, well, what's the purpose of the rule, right? So again, the purpose of ABLE is to encourage investment by making you better able to utilize allowable capital losses, right? And they do it by way of a reclass mechanism. Principal residence is a mechanism that's there to try and exempt gains on, taxpayers from recognizing gains when they sell their principal residence. So it's very unrelated in that respect, right? Again, very easy to mix up rules, but that's why I'm going to keep hammering. You'll hear me nag all the time about steps and triggers, but really it's all about understanding the concepts, and making and this forces you to understand the concepts. Anyways, so for the next part on the changing the year, the difference now is your inclusion rates are different, right? Remember we talked about those historical capital gains rates, right, in the past. And so because this is now in 1989 versus 2009, your exemption, your capital gain exemption rate, your capital gain rate is different. So in 1989, the inclusion factor was 66.67%. Okay, so if I gross up to 15,000, so remember 15,000, if I want to do my gross up formula, right? 1 minus 0.666667. Okay. Did I do that right? Oops, sorry. It's not 1 minus. So if I divide it by 66.67% and I gross up, that says in the past, I must have had a 22,499 or 22,500 capital gain in 1989 in order to say 15,000 is taxable. Okay. So because I had historical, capital gain now of 22.5, now when I go and do the calculation, I'm a net loser by 22.5, and half of that is 11,250, right? So again, and to better illustrate, right, if I had this and I had again, 66.67%, right, inclusion factor, that would get me to 15,000, right? So again, this is the gain I had in the past, the capital gain. If I do my calculation, I'm a net loser by 22.5. Half of that is 11,250. So now when I do my section 3 format, I now will reclass 11,250. So I take that out from here and put it into 3D. And now I'm going to have a 148,750 NITP. Okay. Does that make sense? So this is, again, another integrated point where now all of a sudden we bring in the historical taxation years. And so you need to capture that. Does that, any questions on that piece? Everything else in the question obviously is the same. No, like that's a rounding error. Like this really, like if you do enough, like you're gonna go exact, right? Like eventually it'll be exact. Like if I just go extend it all the way out enough, right? Oops, not 0. You know, it'll be eventually this will get to exactly 15,000. Still 14,99999, but you're going to get exactly to 15,000 at some point. So if you're off by $1, no one's going to care. So again, this is an example, guys, of how easy it is I'm hoping you're getting to sense now. For chapter 8, I literally could take almost any topic that we've taught in the last 2 weeks, and I can integrate it with another topic fairly easily in these questions. So I cannot emphasize enough that you guys really need to, when you go into a chapter 8 question, to look at the question and identify all the topics in play first. Look out for triggers, just like when I showed you guys when I was reading the question, doing the midterm in front of you. You got to make sure you're picking out your triggers as you're reading the question and making sure you always identify the topics that are in play, because we can easily sneak in something just by adding a couple sentences. Okay, so again, are we good on this part? Okay. The last part, part 3, what happens if you had 500,000 that was exempted in the past? Well, if you take a look at this, if you did this 45,000 and now you're at minus 500,000, okay? Well, at the end of the day, you're not a net loser. You're a net gainer, right? 45,000 was our SBC loss. You back out 500,000 capital gain, you're a net gainer. So guess what? Can you claim an ABLE? No, you can't, because you are not a net loser. Okay? So part 3, basically the answer is no ABLE allowed, because you had more benefit on the gain side than the losses that you've experienced. So you're a net gainer. Sorry, no ABLE. Okay? So that's the answer in part 3. If that makes, hopefully, is there any questions on that one? Superficial problem, superficial loss. So let me ask you, the guys up front, does it matter whether you buy first and then you sell, or sell first then you buy? Does it matter in the context of the question when you looked at the question? Does it matter? Are the numbers going to be any different? Okay. Are the numbers going to be any different? Right? Because again, in the scenarios, right? If John Smith sold 1,000 shares first, then Caitlin bought 600, or right? So affiliate person bought 600. Or here, John Smith first purchased 600 shares, then sold 1,000 shares. Okay. Doesn't matter. Or are the numbers going to be the same? Right? Because everything is within that 61-day period. So is the numbers the same for both scenarios? Are the numbers the same? Marie says different. Here, let me do a poll. I'm going to do a poll. Okay. So A said, if you say A, that means you're saying the numbers are the same under both scenarios. If you say B, you're saying the numbers are different. So do you think it's the same or do you think it's different? More people are going different. Plus, I only have 19 people in class that are paying attention or have done their homework. That means I got 10 people who have fallen asleep. That's not a good sign. Oh, come on, people. What happened to the people that are on the chat? All right, anyways. So here's my question. Why are they different? And please don't tell me, oh, Chris would never make it that easy. How could it be this? It can't be the same. Why is it different? Because the average cost per share is different. Do you guys agree? Does anyone have any other opinion why they're different, or is Marie's point the correct point? Why don't we use FIFO? That's because I told you in week 7 of Durzak, tax does not use FIFO. You must use weighted average under the identical property rule. So that's the big thing is we just changed the ordering, and now we introduced the identical property rule, right? Because you have to do weighted average calcs. Again, how easy is it for us to slip in concepts that have been discussed in class? Very easy. Just got to change one little fact, one little sentence. So, if we go through the question, okay, again, if you want to go through your triggers, so before we go into the numbers, okay, who remembers what are the 4 triggers that have to be met in order for you to have a superficial loss rule? What are the 4 triggers that have to be met? What's the first trigger? We talked about these 4 in the. All right, so first one, disposition that results in a loss, right? If we look at the scenario, sells for 1450, bought for 23. All right, that's easily a loss. Now what's the next thing you have to look at? What is the specified time period? Plus minus 30 days from when? Right? So you have to remember, you have to be very specific. It's 30 days before and 30 days after the disposition date, right? So again, your disposition date is August 20th, right? That's my disposition date. My disposition date is August 20th. So it's got to be 30 days before, 30 days after. All right. So what is my 30-day before point? Okay, so July 21, right? On the basis that July is a 31 days. And then what's my 30-day after point? Okay, so there's my 30 days before, there's my 30 days after. Remember, it's a 61-day period, right? Because the date of disposal is another date. So if you go through that, all right, so between those timelines, July 21, September 19, was there a purchase, right? So yeah, there was a purchase. So what's your third trigger? What's the third thing you have to evaluate? So what's the third thing you have to evaluate? So you have to look at the period. So one, was there a disposition that results in a loss? Yes. Two, now you look at your time period, right? Was there a purchase? Okay, so there's a who. When we say who, well, who's the who? When we're saying we have to worry about who acquired the property, who are we looking out for? So okay, so taxpayer. So remember, John Smith is a taxpayer. So did John Smith purchase shares or affiliated person? Well, what defines affiliated person? Spouse. Okay, that's one. What's the other key one? No, not child. That is not an affiliated person. So there's spouse or common law partner, or that's right, and this is key. Don't just say corporation. It's a corporation that's controlled by the taxpayer. That's really important because you can create different scenarios where you can even have a situation where, for example, let's say you own 30% of a corporation. Now, you might say, Chris, well, if you only own 30% of a corporation, you don't have control. But what happens if I said, but you have the ability, you have the right to acquire 20% or 25% of the corporation for $1? Now, all of a sudden, well, yeah, you only own 30, but you have the ability to acquire 25% whenever you want. So in effect, you can put yourself into a situation where you own more than 50% of a corp, and it's very easy to do. Well, in effect, you do control the corp from a tax point of view. Okay, so it's important to say it's not just a corp. You have to say it's a corp controlled by the taxpayer, because there are many different scenarios in life where you can acquire or you can have control without even owning majority of the shares. It is possible. Okay, so it's important to say corporation controlled by the taxpayer, or some variation on a theme on those two. Okay, but basically those are the two. So taxpayer or affiliated person. So in this case, in scenario one, within that time period, it was Caitlin. Now, one of the things you can argue I should have said was I should have made it clear that that was his spouse. So if someone wanted to really pick a bone with me, you could argue, Chris, you should have made it really clear it's a spouse. Okay. So, but I'm telling you now, for sure, this was meant to be the spouse. In the scenario two, John Smith himself purchased it. So therefore, in case of John Smith, that he's a taxpayer. So in both cases, it's been met. So what's the last trigger? So now we've established sold for a loss, purchased within the time period, within the 61-day period, and it was substituted property purchased by taxpayer and or affiliate person acquired the shares in the time period. When we say at the end of the period? What day? At the end of what day? In this case, in this question, did you have do we have to hold by? That's right. So the question is, at the end of the period, at the end of the 61-day period. So don't just say period. At the end of the 61-day period, did the taxpayer or affiliated person continue to hold? Okay, so Sarah, your trigger is not quite complete. At the end of the 61-day period, did the taxpayer or affiliated person continue to hold? So in other words, did Caitlin in scenario 1 or did John Smith in scenario 2 continue to hold after September 19th, 2019? And in this case, we did not discuss that there was any disposal afterwards. So presumably, they did continue to hold after September 19th, 2019. Oh, sorry. Yeah, in this case. Okay. So all 4 triggers have been met. So now you have a superficial loss. And the key thing to note is you start off with 1,000 shares. Okay. You start off with 1,000 shares. You ended with 600 shares. So again, in both cases, you start off with 1,000, you ended up with 600. So at the end of the day, you would say, Chris, you only really sold 400. So 40% of the original loss is recognized, 60% is superficial. Okay. So if I go through the calcs, okay, and the key thing here is if we go through this question, say you look at this student, right? There's some things that need to be fixed. There's some minor quibbles, okay? But my biggest thing here is, did they clearly identify the person right up front that's experiencing all the consequences? And I would argue no. There's some discussion about who recognizes what, but I would say this is not as clear as I would want it to be. How would I want it the calculations laid out? Again, the first thing I do, I just show the person and I show the year. Okay? So again, I show the person and the year right up front. Because again, with superficial loss, it's very important that you make it abundantly clear who is getting what tax consequence. Okay? So in the case of John Smith in scenario 1, he did the sale. So first things first, he has 8,500 loss, okay? Capital loss on the sale of the shares. Now, at the end of the day, 40% is realized. So if we take the 8,500 and split it up, 3,400 is realized, 5,100 is superficial, okay? So this 5,100, what happens? It's deemed to be, this is deemed to be nil. Bugger off Excel, right? So that 5,100 is deemed to be nil because that is superficial loss. The 3,400, that's going to be realized. So again, at 50%, right? At 50%, that's going to be 1,700 realized. Okay. Now, for his ACB, right? So if I look at the 600 shares, right? You had purchase of 82.50. You spent 82.50 to buy these 600 shares, okay? Plus, you have, pursuant to 53(1)(f), okay, the denied loss. So what is the cost base of the shares at the end of the day? The new cost base of the shares is going to be 13,350. Okay, but here's the trick. Here's the trick. Here's the thing that you have to think about in scenario one. Okay, who holds the shares? Oh, wait a minute. Caitlin bought the shares, not John. So when you're going through this, right, you want to sit there and say, oh, wait, I got to make it really clear. This is now for Caitlin because she was the affiliated person. And she's the one who gets the 13,350. Okay? She's the one that's going to get this 13,350, not John. John bought the shares and he sold shares, right? Originally, he held 1,000 shares and he sold the shares, but he was not the affiliated person who bought the substituted property. Caitlin was. So Caitlin's 600 shares, they're going to get that denied loss added to the ACB. She's going to have the higher ACB. And when she sells these shares, she's the one who's going to recognize the benefit of the loss. Okay? So, just a tip, if you ever really wanted to know about the finances of your spouse, just go and tell them, hey, you know what, spouse, I learned about superficial loss rules in tax. I should know your investment details because those could affect I need to make sure that there's no superficial loss in my portfolio. And by the way, if you guys, I don't know if you guys think if it's a joke or not, but when I was in public practice, I had one client, he did not want his wife to know about his finances. So he would actually arrange for a suitcase of all his financial details to be shipped to our office every year or at April, so that when we do the tax returns, his wife would have zero idea of what he made on the investments. That actually happens. Scenario two. Oh, sorry, before I go on, is there any questions on scenario one? Okay. Scenario two. So John Smith sells it, right? He's the one who sells the shares again, but instead of just selling right away, he buys 600 first, then he sells. Okay. So the big issue is now I have to do a weighted average. Okay. So when I do my weighted average, now my average cost per share is 19.53. So when they actually do the sale, now I only have a $5,000 loss on the sale of shares, not 8,500 like we did before. Okay. So again, my cost base has gone down. Okay. So again, proceeds of 14,000, cost base of 19,531. You're going to have a loss of $5,000. Now, ignore this for a second. This is based on a whole CRA view. Someone wrote to the CRA saying, CRA, doesn't matter if you buy first or sell first. Okay. So end story is, you don't need to memorize this for your exam. Just remember, before any of the transactions, you had 1,000 shares. At the end, you have 600. So again, 60% is superficial, 40% is realized. So at the end of the day, you're going to have 3,000 superficial, 2,000 realized. And again, at 50%, right? At 50%, your allowable capital loss is 1,625. Okay. So now what happens to the superficial loss? Again, this is going to be nil. You can't recognize it. But that will be added to the ACB of the remaining shares, which in this case is going to mean you're going to have an ACB of 14,737. Okay. Does this make sense? Right, remember, 31,250 is the total you spent, less than 19,531 you sold. That's how you got to 11,718. Are we good? Okay. Okay, with that, then what we'll do is we'll take a break. It's 10:45. We'll resume at 11. We will go through, I'll talk a little bit about change in use. Then I'll talk about the presentation. I'll talk about one or two good things, one or two bad things, and go from there. Right? Like right here, Marie. Right? Again, you have to remember your cost base is now adjusted because of the weighted average. So your cost base is 19,531.